Hi, friends. Welcome back to the Multifamily Review. I'm your host, Marcus Armstrong. We're recording this episode on August 7th, 2026. And today is one of those days where two stories land at once, and you have to figure out how they fit together. So story one, the July jobs report just dropped this morning. Non-farm payrolls came in at a negative 23,000. That's a net job loss. And the prior 2 months were revised down a combined 103,000. Story two is that Jackson Hole is 20 days away, August 27th through the 29th. And for the first time in years, nobody knows what the Fed chair is going to say. It's not Jerome Powell anymore. Kevin Warsh is running the Fed now. He's been the chair since May 22nd, and Jackson Hole on August 28th will be his first keynote in that role. And for multifamily operators, what he says or doesn't say is going to shape the next 12 to 18 months of deal flow, refinancing, and capital stack math. So, why is this Jackson Hole different? Let's start with some context, because Jackson Hole means different things in different years. Some years it's a non-event. The Fed chair shows up, says nothing new, everyone goes home. But some years, it absolutely moves markets. Ben Bernanke signaled quantitative easing 2 from that stage. Powell stood at that podium in August 2022 and delivered 8 minutes that wiped $2 trillion off equity markets in a single afternoon. This year is different for 3 reasons. First, it's Warsh's debut. His first Jackson Hole speech as chair. Markets will parse every single word. Every sentence is going to be read as a statement of doctrine, not just a simple policy update from him. Second, Warsh has been explicit about his discomfort with forward guidance. He's skeptical of the dot plot. He said publicly that locking policymakers into projected rate paths compounds mistakes when the economy shifts. That means the traditional template, here's where we think rates are going, here's our data, dependence framework, may not apply at all. Warsh may deliberately leave more ambiguity than markets are used to. That ambiguity itself is the signal we're trying to track. Third, the official symposium theme this year is financial innovation, implications for payments and policy. So digital payments, CBDCs, fintech. That is not a rate policy topic, and yet the macro backdrop, 5 consecutive Fed holds, a rate hike seriously on the table, and now a negative payroll print, means that Warsh will have to address the elephant in the room, whether the official agenda invites it or not. Jackson Hole has always been about the subtext. This year, the subtext is everything. Here's where we stand heading into that speech. Federal funds rate is between 3.5 to 3.75%. That's where it's been since late 2025, when the Fed made its third consecutive 25 basis point cut. It has not moved since. 5 consecutive holds, all of 2026 so far. In the June FOMC meeting, Warsh's first as chair sent a message that made bond markets uncomfortable. The median 2026 dot on the dot plot moved to 3.8%. 9 of 19 FOMC officials said that they see at least one rate hike before year end. The July meeting on the 29th held again, but a handful of members voted to increase rates. That dissent is notable. The last time 4 Fed officials dissented on a single decision was October of 1992. The reason hikes are on the table: inflation. The Fed's preferred gauge, core PCE, is running at 3.3%. Headline CPI eased to 3.5% year over year in June, which is directionally better, but it's still not the 2%. And Warsh inherited a Fed where the conversion had already shifted from when do we cut to do we need to hike. The war in the Middle East drove oil prices earlier this year. That's been a key inflation input. This is the environment that Warsh walks into on August 28th. Here's where this morning's data gets interesting. July came in at negative 23,000 non-farm payrolls. Unemployment held at 4.1%, but the number underneath the number is more important. May was revised from plus 129,000 down to plus 63,000. June was revised from plus 57 down to plus 20,000. So combined revisions, minus 103,000. We have been operating on faulty data. The labor market was softer than anyone was reporting in real time. The market reacted immediately. Rate futures cut the probability of a September hike from 57% before the report down to 43.9% after. The probability of a September hold jumped to 60.4%. In one morning, the hike narrative got complicated. Where did jobs fall? Local government, education, retail trade, leisure, and hospitality has been under pressure since June. And where did they grow? Healthcare. Again, healthcare doesn't care about rate policy. It cares about demographics. Average hourly earnings came in at $37.64, up 3.5% year over year. The average work week was unchanged at 34.3 hours. Employers aren't slashing hours, they're just not adding bodies. This is what Warsh walks into Jackson Hole carrying: a labor market that is visibly cooling, an inflation problem that isn't solved, and an FOMC that was leaning towards a hike before this morning. So what does Warsh actually say? Here are three scenarios I'm currently tracking. Scenario 1, he signals a hold. He acknowledges the jobs data. He says the labor market has softened faster than expected. He reaffirms the Fed's commitment to returning inflation to 2%, but explicitly takes a near-term hike off the table. The market reads this as a green light for rates to drift lower. The 10-year moves down. Mortgage rates, currently sitting around 6.58%, start to ease toward the Fannie Mae forecast of 6.4% by year end. For multifamily operators, this is the scenario you want. Lower long-term rates mean cap rates can compress, deals start to pencil, and the refi wall of 2021 and 2022 vintage floating rate loans coming due gets a little bit more manageable. Scenario 2, he keeps optionality open. This is the most likely outcome given everything we know about Warsh. He's anti-forward guidance by philosophy. He's unlikely to make firm commitments from the Jackson Hole stage. He acknowledges the data on both sides: softer jobs, still elevated inflation, and says the Fed remains data dependent and will decide at each meeting. No hike signal, no cut signal, just we're watching. Markets may read this as a mild hawkish lean because it doesn't explicitly rule out a hike. Rates stay range-bound. The uncertainty premium that's been baked into multifamily underwriting stays where it is. Deals that pencil today still pencil. The pipeline doesn't open up meaningfully. And then there's scenario 3. He leaves the hike option on the table. He emphasizes inflation is not conquered. He says the Fed cannot let one soft jobs report change the committee's overall assessment. He uses language that suggests September is a live meeting for a potential increase. This is the tail risk. If it happens, long-term rates spike. Mortgage rates move back toward the highs. For operators with floating rate paper maturing in the next 12 months, this is the scenario that forces difficult conversations with lenders. Warsh has acknowledged publicly that the current rate environment is having an uneven impact on real estate and housing. He knows what a hike signal does to the sector. Whether that knowledge shapes what he says on the 28th is the open question. So let's get practical, because that's why you're here. First, floating rate exposure. If you have bridge debt or any floating rate paper with a maturity in the next 18 months, you are in a window that requires active management. Don't underwrite a cut. Don't underwrite a hold. Stress test at today's rate and at the rate plus 50 basis points. Know exactly what your coverage looks like under both. Second, the refi environment. Mortgage rates at 6.58% mean that deals underwritten in 2020 and 2021 on very different assumptions are under pressure. The math on conventional refinancing is tough right now. Warsh's comments on August 28th may move rates 15 to 30 basis points in either direction within the week. That is meaningful for deals you're trying to get to the finish line this fall. Know your rate lock windows. Third, for new construction, starts have been depressed. The financing cost environment has kept a lot of projects on the shelf. The Road to Housing Act, which became law last month, updated FHA multifamily loan limit formulas and created the new low-income housing tax credit runway. That matters, but it only helps you if the cost of capital comes down enough for deals to actually underwrite. A hold scenario at Jackson Hole gets you closer. A hike scenario pushes that further out. Fourth is acquisitions. Cap rates have been slow to move in some markets because sellers anchored on 2021 valuations haven't fully reset. The longer rates stay elevated, the more that reset has to happen. If Warsh signals a hold, you may see a window open in Q4 where motivated sellers and buyers meet at realistic clearing prices. Watch for it. And fifth, the number from today that matters the most is for demand wage growth at 3.5% year over year. That is rent supportive. It is not rent accelerating. If you have aggressive rent growth assumptions in the back half of your hold period, today's labor market data is telling you to stress test them. 20 days is a long time in this environment. Here's what I think you should be tracking. The July CPI report comes out on August 12th, 5 days from now. If inflation comes in hotter than expected, the hike scenario gets more weight even with today's weak payrolls. If it comes in softer, Warsh has room to take the hike off the table at Jackson Hole. That report may be the most important data point between now and the 28th. Watch oil. The Middle East de-escalation earlier this summer sent oil towards $67. That has been a disinflationary gift for the Fed. Any reversal puts upward pressure on inflation expectations and back on the hike table. And watch Warsh. He speaks at Jackson Hole on August 28th. His framing, not just what he says, but how certain or uncertain he sounds, will tell you where the Fed is headed for the rest of 2026. Here's the honest frame for where we are. The Fed is at a genuine decision point. The data is sending mixed signals. Warsh is a new chair who is skeptical of telegraphing his moves. And in 20 days, he's going to get up on the stage in Wyoming and say something that will move markets. For multifamily, the stakes are straightforward. A hold or cut signal opens doors. A hike signal closes the doors. The jobs report this morning moved the needle toward hold, but it didn't close the question. The structural case for multifamily hasn't changed. 3.7 million units short, a housing bill that's now law, and demographics that favor renting. But the cyclical environment, rates, financing costs, and demand softening at the edges requires precision right now. Know your exposure, know your maturities, know your renter base, and be ready to move when the window opens, because it will eventually. Thanks for listening to the Multifamily Review. Be sure to like and subscribe. I'll see you next episode.